Today, we are talking stagflation. It's a term you may have heard recently because it's come up because of the high inflation and the potential stagnant economic situation. Stagflation is a period of economic time that's typically defined by slow economic growth, hence stagnation, slow economic growth with inflation. So you get the stag from the stagnation and you get the inflation from the inflation. You put it together, what do you get? Your stagflation. Term started in the 60s or 70s. Back then, the only time that it had ever occurred really was kind of in the oil shortage. Oil prices skyrocketed, caused inflation. At the same time, consumers were left with a ton of unemployment and a ton of expenses. Therefore, GDP went into negative numbers. They had a recession. First time the term was ever coined, first time the term was ever used. Now, inflation typically comes with more dollars chasing fewer goods. So you wouldn't typically see inflation in a period of economic stagnation. So it's somewhat rare. It used to be somewhat rare to see a period of stagflation because obviously if we have so much money in our pockets, us as consumers and businesses and the government, that we are chasing goods, it's typically a good sign for the economy, right? We have a lot of funds, we have a lot of dollars, we're wealthy, we're independently wealthy, therefore we're able to pay more for products and services, therefore there's inflation. But usually that's coupled with a period of economic growth, inflation typically. Usually that's going to be coupled with a period of economic growth, at least in North America. Historically, that's what we had seen. Inflation in other countries, heck, that's a different ballgame because they could be printing an obscene amount of currency. You can get into these weird situations where inflation just takes over an economy like we saw in Venezuela and in certain African countries. So this stagflation also led to something called the misery index. The misery index is pretty simple. You simply take two numbers and you add them together. One is inflation, year-over-year increase in the CPI, the consumer price index, goods sold. How much more are we paying today than we paid a year ago? That's inflation. And two is unemployment. So if you add your inflation and your unemployment, you get the misery index. And the misery index is one that measures, some would say, stagflation. If you have high unemployment and very high inflation, you are in a period of stagflation. So do we have that right now? Well, economic growth is abundant right now. Now, that's not to say that we're not going towards a recession, but right now, currently, there is economic growth. There's labor shortages. It's becoming difficult to fill those job positions. And there's likely to be labor wage inflation as well. Now, we also had the yield curve inverting. So whenever you get the yield curve inverting, typically you will see a recession in the next 6 to 18 months. So are we going towards a period of time where we're going to see negative GDP growth, which would be economic stagnation, coupled with high inflation, which would be stagflation? It's quite possible that we are going towards a period where we might see some of that. So what was historically something extremely rare, right? You see inflation and you see a decline in the GDP or a negative growth number is now more and more common. If you look at every declared recession in the US over the last 50 years, every single one of them has had a year-over-year increase in the price of goods, therefore inflation. Inflation has come along with recessions over the last 50 years. So what's the cure for stagflation? Well, I don't know, but I will say this. Over time, you will see goods coming on board again. You will see more labor entering the workforce. Prices can't continue to go up forever at this level without natural market forces coming in and regulating themselves. So over time, producers will come on board and produce the goods that are in short supply, therefore reducing the price, therefore reducing the year-over-year inflation number. That will also lead to production, and production typically leads to job creation, and job creation typically leads to a boom in the economy. So is it just a matter of time before this sorts itself out? If we do get stagflation, maybe, but it might also be just the natural market forces taking effect and time getting you onside back to a period of economic growth and normal inflation. All right, guys, thanks for tuning in. I'm Rob Tetrault from robtetrault.com. Don't forget to subscribe, give us a follow, give us a like. We'd love to hear your comments. If you'd like to book a no obligation consultation, please go to www.speaktorob.com. We'd be happy to chat with you about your portfolio or how you can improve it or how to protect against inflation. Did you consider alternative assets as a neat hedge against inflation? Check out our other videos on that. Thanks for tuning in, guys. I will see you in the next video.